I'm Andre, and I'm joined with.
This is Brent Sullivan over here.
Can you see my shirt? It says first. I wanted to do a little bit of trivia. Who was the first person to fly a powered aircraft?
Oh
Not
boy,
a
powered aircraft.
the first flight.
Oh, like the Wright brothers?
In Brazil, they have a lot of national pride around Santos Dumont, and they will strongly debate that instead of the Wright brothers being the first, that Dumont was actually the first to do a power flight. And they'll go very deep on technicalities around the Wright brothers using some kind of catapult, and that it was not in public. It was like hidden off in off the cliff somewhere, and it was assisted and it wasn't powered. And it will just go super deep into that. But that's a Brazilian view. It's very much on no, Santos Dumont was first and the Wright brothers are wrong.
Yeah, my gut reaction to that is that's some healthy debate from our neighbors down south.
So someone asked a question on explain the recommendation regarding organic versus non-organic avocados last time. That's a good question. I think as prices go up, consumers look to make substitutions. And I think organic to non-organic is one of the easy substitutions to make. I think on top of one of the benefits of organic is avoiding pesticides, and certain fruits are more susceptible to that. If you're eating berries and fruits, you're eating the outside of the fruit. But with something like an avocado, it has a hard shell. Same with the banana. You're not licking the outside of it where you would be more susceptible to ingesting the pesticides. So something like an avocado, it doesn't matter as much in terms of organic versus non-organic. So you can save those $1 to $2 per bag and pick up the inorganic avocados. I have in front of me a nice California avocado until from Costco, of course. It's still $8.99 for a 5-pack for the non-organic. I'm still waiting for the California growing season to end and see what tariffs end up doing to my avocado prices.
Okay, so this is a good segue. Before we jump in here, just the really quick, we'll put on the disclosure. So again, the not financial advice, not tax, legal, or investment advice. This is not an endorsement of any product or strategy, approach, vendor, any of that stuff. This is just general conversation, really educational in nature, informal, and not about anyone's particular circumstances. Consult a practitioner, credentialed, all that stuff. It's not us. We're just here having a good time talking about stuff that we think applies to a lot of people, but not you specifically.
Definitely not you. And today, I think we wanted to dive in a little bit deeper and talk about concentrated positions, holding too much company stock, and how that happens and some of the solutions around that. So I thought maybe we could start with a quick recap of, at a high level, RSUs, and then we dive in. We didn't have enough time last week, but we'll have enough time this time. RSUs, one of the most common reasons why people even run into this problem, where they have too much company stock to begin with, is that their company keeps giving them more stock, or the company gave them stock and it appreciated significantly over time. So I always start the initial RSU conversations all around RSUs. It's a big portion of your income. And when you're thinking about it as it's coming in, I want everyone to be thinking about RSUs as income, because from the IRS perspective, RSUs are taxed as income regardless of whether you sell or not. At the moment of vest, they're taxed as income. So if you sell right away, you're not paying any additional taxes if there's no additional capital gain. However, that changes if you don't sell right away. As you continue to hold your company stock, and particularly if you've been within tech or within FAANG, you can very easily find yourself with significant capital gains on all of your lots. And maybe you've been working there for 5 years, 10 years. So some of your initial grants that you didn't sell, because it's very easy to just not do anything. That's like the default status is doing nothing, and the RSUs will accumulate. So you end up with significant amounts of your assets tied to your company stock. And that's the main topic today, is all around why that might be a problem, or if it is a problem at all, and maybe some of the things that you can do to unwind those concentrated positions and what the pros and cons of each different option would be.
I like it. I think we were talking about this a little bit offline, but the first question is just like, is this actually a problem? Do we agree, and not me and you, rhetorically, do we agree that the concentration is a bad thing? And, or that maybe there's a point, just like the avocado, it gets a little too ripe, and then you're like, oh, I'm stuck with this kind of problematic asset. So I think that's probably the first question. How much is too much? And is there actually too much? I'm curious what you're hearing from folks on your end.
It is very hard to answer that when your stock is at an all-time high. What I've found, and I've been talking about diversification within FAANG for, I don't know, like the last 10 years. People don't care about diversification when things are all-time high. Like it's you're being rewarded for doing nothing and things are good. Your portfolios are growing. Why do I have to think about it any more than I would otherwise? However, things aren't always good. A lot of times there's a big revision to the mean, or there's going to be drawbacks or drawdowns on a regular basis. And that's when people suddenly care about diversification. When Meta is at $700, no one cares about diversification. Once it drops down to $100, all of a sudden everyone's, oh, that diversification thing's important. Now I understand. Let me quickly make changes now. And the thing that I like to point out is, particularly if you're within big tech, you've won the income game. And I want people to back up and think about, what are your goals? And do you need to be taking outsized risk? And in most cases, the answer is probably going to be no. You've won the income game. You don't need to also beat the market consistently over time to reach your goals, depending on what your goals are. I've always viewed it as it's a risk thing. And for me, in my fire goals, like I don't want to risk being able to fire entirely depending on whether my company's doing well. And I think for me, again, I was laid off in May 2023. So stocks at a low and I lose the job. So I don't have any future equity coming in. That's like a perfect example of when shit hits the fan, it hits your equity, it hits your job. A lot of the things can happen all at once. And it happens a lot faster than you think.
Yeah, it's like you don't want to be like fully anchored on your company's stock, even though your company might be the one. That's always the argument we hear. And it's just funny to think about some folks who will use their job as a long bet on the company itself. So I've got a friend, I won't say where they work, but it's a mid-cap tech company. And he joins this company, and his whole idea was like, the stock price is depressed right now. A large part of my comp is going to be RSUs, and the grant is going to be low. As the price appreciates and they vest, they're going to vest at a higher rate. I'm going to be compensated in an outsized way versus if I had just taken all cash somewhere else, or if I'd taken a mid growth. Yes, that's like a very privileged very privileged risk to be able to take, because this thing could do nothing. It's a mid-cap tech, so it could go nowhere. As this name has done, it has gone nowhere. It's been flat, and he's grumpy now. It didn't appreciate as I expected, but now he's thinking about, hey, we're doing a layoff round, and the stock really hasn't gone anywhere, and I could have gotten market returns elsewhere for the same amount of work, the same amount of work-life balance, et cetera. So this is concentration manifest. Are people talking about it in your circles that way?
Yeah, I think it's like a similar thing. I think you hit up a good point around one of the key things there is you could have gotten market returns. That's one of the big assumptions that I think is important is it's not about selling your company stock and then doing nothing with it. It's about selling it. And if your goal is to be invested, then investing, at least in my opinion, what I've always done is super boring, broad-based index funds for 90% of my portfolio. If the market does really well, then my index funds will also continue to do well. Not as well as a concentrated position in the currently top 5 performing stocks, but still, it's not going to be 0 or 100%. It's a good, healthy clip, especially the last couple of years. Hasn't been too bad being in the overall market.
Yeah, exactly. And one thing I hear a lot is I've got 60% of my net worth in Amazon shares or something like that. But hey, Amazon, look at their fulfillment center network. It's not going to fail. Amazon's not going to fail. That's actually not what we're talking about. The material risk to you as an investor, that the price is going to draw down when you need the cash. And so you're going to go make that home down payment or whatever. Amazon's 50% off of its max. But of course, you've already paid tax on the shares that vested at the high price. And so this concentration ends up having all these ripple effects throughout your life that are independent of the company failing.
Yeah, all that concentration, it makes me nervous. When we talk about concentration, like how do you think about what is concentration? I've always fell back on definitions around if you have more than 5% of your net worth or 5% of your investments, that's starting to get into that concentration territory. More than 10% is very concentrated. And then when you have people in that 50%, it starts getting super high. How are you as you're going through it? How does the industry typically think about it as you're looking at these research papers? Like what is concentrated and like when is it become a problem or when is it like just a outsized portion of your portfolio?
Okay, so yeah, this is a good segue. So if you look at the image on the screen here, we'll talk about like the specifics, the avocados and all that in just a second. But just notice the author there, that's Auntie Petagisto. And so what he did in this paper is the first question he answers is what is concentration? What's the number that we should be thinking about when things start to get essentially when the volatility from the individual position starts to be the tail wagging the entire portfolio? And he says 10%. Like that's the number to have in mind. And that's when the single stock, the idiosyncratic risk of one position starts to really take over. And so 10%, that seems like a good round number to keep in mind. Of course, I've seen way higher, especially we talk about executives who are highly compensated and they might be very comfortable holding a 50% position. And it has to do with their rights at the company and being able to exert influence because they maintain such a large share percentage, things like that. But that is like not the average case. Set aside executives who are a very special case. There's the rest of us, and the rest of us have got this 10% number, its handle to keep in mind.
Yeah. And I think the one thing that's interesting too is like an interesting curve potentially there where someone that's a new grad engineer joining these companies by nature of if they did nothing for 1 year, all of a sudden they're super concentrated just because they're early on in their career. And then you have the other end where you have executives that have been there a long time. They're also super concentrated, but their overall net worth might be at such a point where, yes, it's concentrated, but the rest of their assets maybe still are enough where they're able to take that outsized risk for that portion of the portfolio.
Yeah, 100%. That's exactly it. Maybe an executive wants to retain voting rights or something like that. And so they are able to take that kind of risk. Age is related to this too, right? You've got a brand new engineer who's starting, he's highly compensated, 50%, 60% of their net worth is tied up in a single name, their first job maybe. And because they've got such long horizon and they're not going to buy a house for 10 years or something like that, maybe they're fine. That's a personal decision. Again, talk to an advisor if you care about that kind of stuff, do your research. It's really a personal circumstance about what constitutes problematic concentration, but is it problematic is the real concern.
And I think that brings up one of the core tenets a lot of FIRE people think about is how will this impact your sequence of return risk, where a lot of the core FIRE principles are oftentimes built around maybe the 4% rule, which is all around being able to sell 4% of your portfolio and then each year adjust that for inflation and then not run out of money over any 30-year period. I personally have used a much more conservative 3.5%, particularly because for FIRE, I'm looking at longer 60-year potential time horizons, and 3.5%, again, obscenely conservative. But that sequence of return risk, the reason that where those numbers come from is all around what is the amount that you can withdraw that will survive these worst case scenarios happening right after you retire, like things like the Great Depression, rampant inflation, oil, booms of the 80s, and all of those types of things. It's all worst case scenario planning. However, that assumes a diversified portfolio, oftentimes like more diversified than people think, around like 50-50, but I think it's worked around all the way down to 90% equities, 10% bonds, down to 50% equities, 50% bonds. The point there is it doesn't assume you have 50%, 10% in a single company. That completely changes your safe withdrawal rate math, and all of these core principles that you might be rules of thumb kind of get thrown out the window when you're dealing with that much concentration. So as you're getting closer to maybe your FIRE number or thinking about taking a step back, this concentration issue becomes even more of a potential risk for you being able to hit your goals. And I think going to age and going to like when you're wanting to pull back and thinking about concentration over your career. And then as you're getting at the end, so I think what you were saying, a lot of times people like to bring up Warren Buffett in this concentration versus diversification conversation. What was his famous quote?
Buy a 5 basis point S&P 500 index ETF after me. It looks for me.
Which is what she recommends too. But I think there's a quote that people take out. It's like concentration makes you wealthy, diversification keeps you wealthy. Using that as an excuse to stay concentrated. But I think as you're getting closer to maybe your FIRE number, the risk of being concentrated becomes even more apparent because in any given month, year, you can have a huge drawdown relative to the overall market if you're concentrated in one specific company or even a handful of companies in the same sector. As we saw over the past year, where one model comes out of China and all of a sudden every company that's doing AI drops 10% completely randomly. Like it has nothing to do with performance. So if you're about to retire and you're relying on drawing down from those portfolio, it makes me so nervous when you see these huge concentrations that people are then using these what seemed like a conservative withdrawal rate on, but the assumptions are completely different when you're dealing with those concentrated portfolios.
That's so funny. So that's, of course, you're referring to the DeepSeek issue from, what was that, March or April. It's so funny. I feel like that kind of got everybody's attention for 5 minutes and then just evaporated as whatever, 1,000 new AI companies popped up. OpenAI, resumed dominance or whatever happened. But the point is that it would be a shame if like in that month, you needed to free up cash to literally make a down payment because you just relocated for a new job or something like that, or you're having another kid, or whatever the reason is. It would be just a shame if you needed the cash right then. And that's what concentration does, is it gives you exposure to that sequence of return risk, sequence of returns. Like, we need a better name for it. By the end of this episode, we better have a better name for it.
And I think like you said, that happened in March. It felt like it was like years ago. I think we have such short-term memories with this stuff. And I think that also causes a big challenge here. So can you make my camera the main one? I'll bring out the trusty tape again and we can see what I have written on it today. So here we have let's see if we can kind of read that. So we have most of the FAANG companies. So we have Meta, 34%, Apple, 27%, Amazon, 26%. And as we rotate over here, we have Netflix, 27%, Google, 30%, NVIDIA, 37%. And these might seem like super random numbers. What we're looking at here is these are the max 1 year drawdowns, like the median 1 year drawdown over the past 5 years for each of these companies. So the median in 50% of the last 5 years, each of these companies saw drawdowns almost in excess of 30%. From peak to trough, you can expect a 30% draw. We've seen a 30% drawdown over the last 5 years. So if so much of your net worth is concentrated within these companies, part of being concentrated is needing to deal with these huge swings. And as you get closer to needing these funds, or anytime you need those funds, that's going to be a big challenge to being able to rely on your portfolio for anything consistently. So let's say that they've been listening on, we're 25 minutes in, and they say, all right, concentration is an issue. I agree. That's the whole reason I'm listening to you guys right now. I'm sitting on 50% of my net worth in my company stock because it's gone up 100% over the last year, and they keep giving me more of it. And I have another vest coming up this month, and there's just vest on top of vest, and earnings were good. The market is uncertain, but oddly good for at least the handful of tech companies that I happen to be working on. Tell me, like, in a not advice way, like, what are my options? What can I even do to get out of this concentrated position where so much of my net worth is in these handful of companies?
Andre, you brought up the easiest solution, and that's just to sell. And I want to, as someone who spends his day looking at the tax code and talking with vendors in this space, really in advisory land, I can say that is oftentimes what folks lead with, even when they're very tax sensitive, very risk sensitive. Hey, does it make sense to sell the darn thing and just be done with it? You had a great quote from last time. I don't know if you remember it, but I can regurgitate it. But maybe try to sprinkle some wisdom on us from, what was it? Return on hassle or something like that.
I think about the return on hassle is just a concept overall around what's the benefit of doing it? Like, how much of a pain in the ass is it going to be to get that benefit? Is the juice worth the squeeze at the end of the day? It's how to think about it. And starting with, if you have a concentrated position, like, one of the defaults, the first things, instead of, people have the tendency of looking at the most complicated solutions first. Those are the most fun to talk about. People are interested in saving money on taxes, and letting the tax tail wag the dog is one of the first things they do, is like, how do I save money on taxes? I don't want to get out of this concentrated position because I'm afraid of paying that tax bill, is one of the most common reasons people will give around staying in those concentrated positions or staying in them too long. They don't want to realize those huge amounts of gains. And sometimes just paying that tax bill and not playing any games, not going in through any complex solutions is like a perfectly fine avenue to do. Sell, figure out how much you want to sell, and then selling in the most tax advantageous way, which means around like minimizing your overall capital gains. So it's not about like blindly just selling anything. It's like deciding how much you want to end up with. So for me, I want people to physically think about it and write down what percent of their overall net worth they would want in their company. Use that as a starting point, and then think about, okay, how do I get to that end point? What is the most optimal way for me to get there? The first thing should be around like, all right, I should sell. What are the implications of me selling? And how do I do that? Then from the selling decision, how do I sell in the most tax efficient way? And a lot of times they'll be using like brokers like Schwab. They'll have options within there around, Schwab calls it like tax law optimizer, will automatically go through and select the shares in the order of, I think, like short-term losses, any lots that you have with short-term losses first, then long-term losses, then any kind of near the current price, both short-term and long-term, and then long-term gains, and then last short-term gains is generally the sequence that they will automatically sell if you select that. I also think it's important to understand what those are doing. I always export out all of your lots, throw it into Excel, and estimate, hey, on an individual lot basis, like what would be the tax implications of selling each individual row item? And for the most part, it's not super hard to complicate, at least at the federal level. I think it gets interesting at the state level too, because most states, a lot of states, it's so different. This is why I think every individual person's circumstances is different. So a lot of times people get stuck in their head around, oh, long-term capital gains are lower. However, if the stock has appreciated a lot, odds are on a per stock basis, you might end up paying significantly more in taxes selling your long-term gains than you would in short-term gains. And it gets complicated on top of that if you're in places like Washington, right? Washington taxes long-term gains, but they don't tax short-term gains in a very interesting twist versus California. They tax all gains. They don't care short-term, long-term. It's all income versus that Washington finding ways to tax gains because they can't tax income. That's the approach. So individually for you, understanding what are the tax implications of selling, do that. Don't let that derail you from selling, but at least understand the implications. Because I think like making an informed decision, and if you can put a physical dollar value of like, all right, I'm going to sell $200,000. I know now and with confidence that my tax bill is going to be around like $50,000. I can prepare for that versus this mystical thing I think people have in the back of their heads around, I'm going to have this huge tax bill. Physically quantify it. And then maybe it becomes less of this mysterious thing. At least it's something that you can make a conscious decision around. All right, is it worth that $50,000 to make this chase? And then look at it long term. All right, does this $50,000 tax bill right now impact my long-term goals? And it probably doesn't. Like at the end of the day, like if assuming you're investing that back into the market in a broad diversified portfolio and that's going to grow on average, like again, like you're still going to take advantage of any upside. And I don't know, it won't impact your goals likely as much as you think it would. And my big thing is physically run the numbers and see what that looks like in your specific scenario. And odds are that default of selling, paying the taxes, not sexy to talk about, boring, but it should be one of the defaults that you have.
If we're talking about time to diversification and we want to talk about some more esoteric stuff, let's take a look at this one here. So yeah, excuse my silly little drawings on top of what is actually very serious work. But the folks over at bought an advisor called Aperio. Aperio is famous for its direct indexing delivered to advisors as a product, but very famous direct indexing company based out of Sausalito, I think, in California. BlackRock requires this company, Aperio, still does research and does really excellent research. Recently, one of the themes of that research has been de-risking concentrated stock. I want to be like really crisp about this. De-risking and not diversifying. You can de-risk without diversifying. The way to do that is with options. If you buy a put option, for instance, you have taken risk off the table because you've got downside protection, but you have not diversified the position. So I want to be clear that there's a distinction between diversifying and de-risking. So I always say de-risking because it really depends like what the goals are of the person, like in this circumstance. Diversification, I would say, is an end state. If you want to go from de-risked to diversified, that is just like another step that you have to do after de-risking. But anyway, okay. So with all that context, what we're looking at here is a way to classify single stock de-risking solutions. And I've got the turtle on one side and I've got the rabbit on the other side. And this is really how fast you get de-risked. This is the speed to de-risking is slow. It just like never happens. You just keep holding the darn thing. You never de-risk. You never take any action to do anything. You just continue holding all that concentrated risk. Now, as we move to the right, we start introducing more complex strategies. One of them is to introduce options. Again, you could buy a put option. Maybe the put option is struck at the current prevailing price. Maybe it's struck a little bit lower. So it ends up being cheaper if you strike the put option a little bit lower. So there are a bunch of different levers you can pull just with using options. Maybe you want to go costless. So you're capping your upside now and you're using the proceeds from the cap to pay for the floor. Those are options-based strategies.
The challenges too with a lot of the times with this concentration is when you're still working at that company, with the trading policy, you're restricted from even doing any of those hedging or buying options in your company stock. So it's like one of those ones that like, awesome, you're working at the company. That's like one of the options people have around de-risking. That's already off the table in many cases.
You really got to check if your company allows hedging. And there are different flavors to that. It usually involves put options. It also could involve shorting. You got to make sure that this is above board at your company. The consequences are severe if you breach. So yeah, just make sure that this is above board at your company. The next thing you could do, this is like what Andre suggested earlier, which is you start out with a concentrated position, you sell a little bit, and then you take those proceeds, you put them into something that can tax loss harvest for you. So it could be a portfolio of ETFs, it could be a direct indexing portfolio, it could be something more sophisticated, like a tax aware long short mandate, which is, we'll turn it up to 11 in a little bit, but that's if you can free up cash from the concentrated position in any number of ways, you can put the cash to use for diversification and to generate some losses that can be used to wind down the concentrated position over time. So we're going to keep moving right here. What if you wanted to get diversified right away? If you were just like, hey, I want to be done with all this risk. Again, you've decided that the hassle of even considering these strategies is just too much. What would you do? So Andre already brought up one of these, which is you just sell the darn thing. Complete opposite of holding, right? You just be done with it. You sell it, you pay all the tax, you take the proceeds, you put them into something else. That'll get you instantly diversified. But then you've got other options here. In this image, they say CRUT. That's a charitable remainder unit trust. That's just one flavor of trust that you can use to affect a gift. But let's abstract out the general concept, which is to give it away. If you give away the shares in one form or another, then you do, by some measure, get de-risked. You can use the tax deduction that you get from those shares. You can invest it in something else. Now, again, I'm hand waving there. That isn't actually how it works, but that's another strategy. It's just a gift.
Concept is around, instead of, let's say that you're charitably inclined and every year you make donations, instead of donating cash to whether you're religious or your schools or all the different things that you funds or causes that you care about, instead of donating that cash, you take your most appreciated stock and donate that instead, because then you're able to offset the donation is valued at the entire top line amount, but you don't have to pay taxes on those gains. It's not an act of selling. And again, that's in the existing year. And then there's also things that you can do around donating shares into, what's it called when you donate?
With the donor advised fund.
Donor advised fund. You can create a donor advised fund with relatively low fees these days. I think like Daffy is one of the leading providers on low fee donor advised funds, where maybe you're going to want to be charitably inclined over your lifetime, but maybe you don't have a cause right now that you want to donate, or the amount that you want to diversify from in a charitable way is not amount you're ready to donate all at this instant. So with a donor advised fund, it allows you to, in this year, move all of these appreciated assets into the donor advised fund, take that deduction in this year, but you still have control over the timing of when you're actually going to be distributing those funds. You can't get that money back out to yourself and use. It's locked up and only can be used for charitable purposes, but it's another option within that give the money away strategy, if that's something that's in your overall life plan.
Yeah, and there are so many like really gnarly and interesting details with gifting. You would think, oh, I give it away, I get a tax deduction, okay, done. But just so it's on people's radars, there are like adjusted gross income limits to how much you can give every year. And it depends if you give cash or if you give shares. And then another thing is how long have you held the shares? If you're donating short-term held shares for a year or less, you don't get as favorable as tax treatment. So there's just like a lot to concern yourself with if you are just going to donate the shares. And then Andre, yeah, there's one more interesting strategy here. There are quite a bit more strategies just from the simplified image here. The other one is the exchange fund. The basics on the exchange fund is that you're going to gift shares and they have to qualify. They have to meet certain standards. And you're going to gift those shares into what's called a partnership. Partnership is essentially a company with multiple owners. And other partners in that company effectively are going to contribute unrelated shares. So if you contribute your NVIDIA and somebody else contributes their Apple and somebody else contributes their Amazon, you could imagine constructing this diversified portfolio of a bunch of different concentrated positions. Now, you get diversified, you don't realize tax just because you're exchanging for partnership units at that point. But the trouble is that you're going to be locked up into that vehicle, the partnership, for 7 years. The reason is what's called a disguised sale. So essentially what happens is you need to hold in that partnership for 7 years so that the IRS does not think you're playing any games, trying to avoid looking like you sold the shares. To avoid disguised sale treatment, all the exchange fund providers will tell you about this. You have usually a 7-year holdup. And that's when you have limited emergency access to the shares. You can usually pay a fee and get them out early, but you're going to get your exact same shares back. So you contribute NVIDIA, you're going to get literally the NVIDIA shares back. But if you wait those 7 years, you're going to be able to withdraw a diversified portfolio. You're going to be able to get back slices of everybody else's shares that they contributed. So exchange fund, very interesting, very cool vehicle. It's definitely like an arrow in the quiver folks should be aware of. Important thing about exchange funds, at least as far as this image is concerned, is that you get diversified very quickly. As soon as the fund closes, we call it a fund, it's a partnership. As soon as the partnership stops accepting new contributions, you are diversified. You own a unit of a bunch of shares that other folks have contributed to this one pooled vehicle. Lots of other trade-offs to concern ourselves with there, but the important thing is you get diversified right away. And this whole picture is just about speed to de-risking.
And is one of the big cons there would be that 7-year hold period. This is funds that you're wanting to diversify anyway, and it's for the long term, like a portion of your portfolio, like that, is that an option if you're thinking about it and you're okay with that 7-year window?
Yeah, I think that's it. Sometimes exchange funds are expensive. I think that's really changed a lot recently, but it was common 30 years ago, 40, 50 years ago. Exchange funds are quite old for exchange funds to cost 1, 2% per year, which is unthinkable if you're an index investor. You're just like, what is this? Like, I'm getting index exposure. What is this for? But nowadays, there's a lot of innovation in that category, both in startup land but also the institutions are also getting more competitive because they see it as really, it's a helpful solution for investors. And it's also very sticky assets for them. In other words, somebody makes a contribution to an exchange fund, they're hanging out for quite a while. So that company is going to collect fees for those 7 years probably. And then 7 years goes by and who do you think they're going to roll their money into next? Probably another product at that exact same company. So I see a lot of fee competition in exchange fund land.
One question on there: what happens after 7 years? What do you get?
So there's a couple things that happens. Let's say the first thing to note is that your cost basis is unchanged. So if you were granted shares of NVIDIA at $100, and I don't know what it's at now, $500 or something like that, you contribute those $500 shares. You wait 7 years, and the shares are now at $5,000, whatever. You get your same cost basis back. So your cost
But
basis
now you're diversified is the benefit, right?
exactly. But now you've got this whole broad portfolio that you're able to withdraw. So yeah, your tax situation does not change.
Like
Yep.
physically, what is
Yep.
that broad portfolio? Am I getting back like 100 different shares of different companies now with that? Again, like that's diversified, but is that what I'm looking at?
Yeah, totally. It depends on the underlying exposure that the exchange fund is trying to achieve, but common exposure, it's all over the map, but it's large cap equity generally. The traditional exposure for an exchange fund was S&P 500. And in that portfolio, you'd get back, let's say 100 to 400 names. It just depends on the vendor. It depends on exactly what they're doing. Other large vendors that you would recognize have Russell 1000, Russell 3000. There's two reasons for that. One is that once the exchange fund bumps up on a certain limit for a name, they just can't take any more of it because they're trying to essentially match an index internally. And so in that case, you'd be getting more shares but smaller slices. And then if you're doing something like a NASDAQ 100 or something like that, you'll get most of the NASDAQ 100. And again, the mandate internally for an exchange fund is really minimizing tracking error. Tracking error just means how much the portfolio behaves differently from the underlying index exposure. In other words, are investors getting what the thing says on the tin? If it says NASDAQ 100, how close did I actually get to getting NASDAQ 100 exposure in that exchange fund?
Yeah. So is it I think like Ben asked a good question around like digging into the various approaches in terms of hassle, initial complexity, ongoing monitoring, tax implications. Is it, if I take a step back and abstract, are the three most common like strategies right now, or like consumer level strategies, is like direct indexing, tax aware long shorts, and then exchange funds? Are those kind of the big three today?
Yeah, I think I would throw in options to the extent that your current employer
Yeah.
allows it. And options are a big one. And it's not uncommon for somebody to just log into their Robinhood portfolio and then to buy a put option on their company shares. Somebody leaves Amazon, they've still got a bunch of Amazon. You can go buy Amazon puts. I would put that in the consumer tool belt. Exchange funds, definitely with some recent innovation for sure. And I'd also put in qualified opportunity zones, which is the real estate product. That is a whole separate topic, but certainly accessible to folks without an advisor. I think long short is still TBD. I know there's some work happening there on the consumer level, but generally that's an advisor led product for now. I think it's coming.
Disclaimer here that is launching a long short directly to consumer, and FAANGFIRE is a partners with Freck. So just as a disclaimer on any potential bias or affiliations there. So it seems like with direct indexing, which I personally have done again through Freck and tax-aware long short, like the name of the game there is accumulating losses that you can then use to offset gains from your concentrated position. Versus exchange fund, it's that instant diversification. It's like the gains are just deferred and then now diversified, which again, if your end goal is diversification, that's one avenue to go. Is that a good characterization? It's like accumulate losses so I can offset the gains, or defer the gains and try to get diversified in some way.
Yeah, the exchange fund, you're going to defer, which is folks will say in tax management, the tax deferral is the only free lunch out there. It's the only magic is to be able to shove out the tax bill into the future. And the reason for that is just time value of money stuff, right? If you don't have to pay tax today, of course, you can invest any cash you've got today and pay off that same tax bill in the future. So it's exactly the same as like bond math. We do the same thing in tax management. So that's on the exchange fund side. And then, yeah, on the direct indexing side, you've got a concentrated position, and then you need to harvest losses. So you're going to realize losses in a diversified portfolio. You're going to take those losses and you're going to try to net them with realizations in the concentrated position. You're going to try to net those two for a tax neutral exit.
It's a little challenging. Like, let's say right now we're already in August. Let's say that you're sitting on a concentrated position right now, and let's just throw out numbers. Like I have a $100,000 cost basis. The stock is now $500,000, so there's $400,000 of embedded gains. And let's say I want to diversify that. And so if I sell now to fund the direct index, I now have $400,000 in gains, and I only have a handful of months this year to be able to offset that. So then in that case, okay, direct index wouldn't have those losses, but if I need those right now, maybe, and I only have a handful of months, like that's one of the shortfalls of like fully offsetting the losses. Again, like partially offsetting it, I think it's like a interesting option.
Yeah, I always think of direct indexing as an incomplete solution for a concentrated position. But I'll put this giant asterisk next to that, which is that if let's say your concentrated position is 20% of your net worth, and you take the remaining 80%, and you put that into a direct indexing portfolio that's going to generate a lot of losses, and typically short-term losses, that matters here, but typically a lot of short-term losses. You use those short-term losses to offset gains as you unwind the concentrated position. And so if you've got this kind of 80-20 blend, then yeah, you can be pretty effective. But when you start to get into higher levels of concentration, let's say I always think 40% is always what I've got in mind, then you're going to have a hard time creating enough losses to actually exit the concentrated position tax neutral, if that's what you care about.
Don't be afraid of the taxes. And this is, again, you can reduce them here, but if your goal is fully avoiding it, then
if we're talking about tax loss harvesting as a means to offset gains realized from a concentrated position, if you live in Washington State, you really have another thing coming. And the reason is because this is maybe a paradigm we'll see elsewhere, but for now in Washington State, a direct indexing portfolio or tax-aware long short mandate will generally generate short-term losses. These are losses from positions held less than or equal to 1 year. Okay, you can't use those losses to offset gains, long-term gains in Washington State. This tool set that folks in tax management use in Washington State, if you're below $250,000 of realized gains, then you're not in trouble. But in Washington, if you're realizing more than $1 million in capital gains, the incremental rate in just Washington State is 9.9%.
What is it? It's 7% above 250, and then over $1 million, it gets that 9%. Is that right?
Exactly. Yeah, we got like what's called safe harbor here, and the safe harbor is just that amount that gets excluded. Yeah. And I think it just got indexed to 270, and thankfully the indexing is codified in the law. I don't take that for granted anymore. Nothing.
$3,000 of income being able to reduce. That is Washington the only state that does that? Because right now, federally, you can use short-term losses to offset long-term gains. It'll have a sequence, like first short-term losses will offset short-term gains, but after you've exhausted all short-term gains, it then goes to long-term gains. However, at the state level in Washington specifically, that is not the case.
Yeah, exactly. It's a very, I don't want to say strange law is what it is, but it's unusual in its treatment. It's a standalone in capital gains treatment. If we compare this to California, for instance, California doesn't care about capital gains and losses. They're just like, oh, you sold a bunch of company shares. That's ordinary income. For these purposes, you can use short-term losses to offset gains realized. And then in California, you would consequently pay less tax. It's interesting that folks would say, oh, California has got these really punitive state tax rates, but you have solutions in California. In Washington, you're much more limited.
Yeah, it's interesting. Even from a fire scenario, earning, like, Washington sounds good because you don't have those state income taxes. But then once you are in the retired state, when you're no longer earning income, now you care more about taxes on other types of non-ordinary income, like things coming from short-term gains, long-term gains, dividends, all of those, which may be susceptible to different tax treatment.
Yeah, exactly. The previous image was all about like how fast do you want to get de-risked? It was all the way from hold the thing so you never get de-risked to give it all away today, and by nature of not holding those positions anymore, in a way get de-risked, or an exchange fund will get you de-risked right away. It was all about time. But there are a bunch of other considerations too. We already alluded to one. I think it's relevant for the fire community, which is liquidity. Do you need access to the capital? Or do you have immediate concerns? Are your kids going to college? Any kind of outlay that you need? Do you have elderly parents who you're going to have to start paying for care or something like that? Do you have cash outlay? Do you need access to the capital? And so that's where an exchange fund, qualified opportunity fund, you're going to be saying goodbye to the capital utility for a while. Whereas something like direct indexing, you could, in theory, withdraw from the portfolio. So that's just another element to keep in mind. Do you have access to the cash, or is it locked in this strategy?
Yeah. So in my personal situation, while I was at Meta, I had always sold RSUs on vest, so I didn't have to worry about concentration as much. However, my wife at Uber hadn't always been as diligent, mostly as a function of like monthly vesting plus blackout windows plus ESPP plus avoiding wash sales with monthly vesting issues. So ended up accumulating a decent amount of gains with Uber's recent run up to $90+. So I have a decent amount of concentration. And one of my plans was like using like direct indexing to accumulate losses over time that can help me keep chipping away at that Uber in a more tax efficient way. Still like taking chunks out as it goes and not being afraid of paying the taxes, and again, doing it the tax efficient way, but also just using that as like a mental softening of the blow of, yes, I know I should just sell it and maybe bite the bullet, but it's easier to stomach sometimes emotionally. Again, we're emotional creatures. It's hard to completely get away from that. And using some of those losses to offset that. And again, this year has been decent, especially at the beginning of the year where we had some big volatility swings and able to harvest hundreds of dollars of losses per day that I can then use this year to offset any gains that I have. Or I think people oftentimes forget too, let's say that you're anticipating a big capital gains in the future. For example, maybe you have a big like 1-year cliff in the future, or maybe you have a house sale that's beyond the $500,000 capital gain exclusion, or your company is going to go IPO in the next year. In anticipation of that, you can use some of these other strategies like direct indexing or tax over long short to build up the losses, because all those losses every single year, they'll keep carrying forward. If you have more losses than gains, $3,000 of those losses will be used to offset your ordinary income. But then beyond that, it just rolls over into the next year. So if you have $100,000 in losses accumulated over the past couple of years in anticipation of a large capital gain, that's where these strategies can also come into play. It's more of I anticipate a capital gain, so then I can use some of these strategies that's not instantaneous, but over time can build up some of these losses. And that's where I think it's powerful for something like direct indexing if you're early in your career and able to contribute regularly, versus if you're like later in your career and ready to get out, it becomes less advantageous, at least on paper, in terms of a tax deferral strategy.
Yeah, 100%. The only place where there's a couple carve outs, but the only thing to just have way in the back of your mind is if you die with a bunch of accrued capital losses, they just expire. They're gone. Yeah. But that doesn't mean don't go get them, because you'll get step up in basis, things like that.
So in my case, it's mostly owned by a family trust. So it'd still be good for my partner to have, and anything staying within the trust. But then if we both pass away, that's interesting. I didn't realize. So when you die, typically your stock, you have that stepped up basis, but you've wasted that tax deferral. So maybe like on your deathbed, realize all of your losses. The name of the game. Do I need to write that into my health directive? It's like, before you pull the plug, please log into Schwab and realize all these losses ahead of the time to fully take advantage of my lifetime simulation of tax losses.
Yeah. So definitely not estate advice here. One thing that folks will do is they'll take the portfolio, they'll put it into a trust that removes their assets from the estate. Then their heirs assume the portfolio and they assume the entire state of the portfolio. So that's gains, losses, realized, unrealized. And then the trust is also filing its own tax return at that point. Yeah, there are options, there are ways. But
that's a super good point though too. Like when you're gonna need the funds? Because maybe something like direct indexing where you have a ton of different positions and you're accumulating losses over time, but then realize those losses. But you still have a lot of built-in gains because again, it's not a full free lunch. It's all around, you're increasing the amount of gains that you have embedded within there because you're reducing your cost basis every time you're selling for losses. You're going to end up with a ton of positions with significant gains over time. When you die, if your plan is to not spend these down, and the plan is to leave those for your heirs, they get the stepped up basis and all those gains disappear from that point on. That just goes into the complexity of not only tax planning and thinking about it for your lifetime, but thinking about the lifetime of those funds and when they're going to be used. It sometimes goes beyond you. And I think that just highlights the complexity of these types of problems and where the tax planning opportunities just get really interesting. Like, how do you reduce your lifetime taxation if you're dealing with the funds around it generational? It gets super interesting. I didn't fully appreciate that.
yeah, there's also this thing, I'll just put this on your radar. In certain cases, you get what's called spousal step up. And so that's, you both don't have to kick the bucket. Your spouse can get a big tax benefit too. But yeah, it's a very interesting world to spend your time in. I highly recommend it. There's some really fascinating multi-generational tax planning opportunities if you're above gift and estate limits and things like that. But for most folks, just some thoughtful planning, I think probably a living trust just to avoid probate, that kind of stuff makes sense.
Yeah, that's the way I'm planning on going. So rounding things out and bringing it back, overall, what are the different options? We have concentrated positions, and what are the ways that we can deal with it? Like, I think we're starting with just selling them and paying the tax and moving on from there. The lowest return on hassle, maybe some higher tax obligations in the short term, but then you're instantly diversified, no issue. And then what your mental model?
So selling is definitely and by the way, this always reminds me of like the Daft Punk song. What is it? Sell it, build it, click it, twist it, whatever. You know the song I'm talking about.
Yeah.
Okay, but that's how I think about this stuff. I'm just like, okay, you can sell it, you can give it away, you can hedge it, and then there's a lot of other stuff. Those are like the three main kind of things. And so the simplest model is, sell it to get out of it. If you want to get it diversified right away, think about solutions around gifting and then also around an exchange fund. And then if you have more time or if you have an upside perspective on this thing, you can start doing fancier stuff. You can start introducing direct indexing. You can think about long short. You can think about option overlays. That could be a collar, whether it's costless, net credit, net debit, just depends on your circumstances. Or you could think about a protected put. And then beyond that, ultra high net worth type stuff, you can think about what's called a variable prepaid forward, which is essentially a collar with a bunch of caveats attached to it. It's a collar plus a loan. And then eventually, once you've exhausted all of this cool palette of options that you've considered, oh, and by the way, you can mix and match them too. Once you've done all that, you can just never take action. And so there's the spectrum all the way from getting diversified quickly or getting de-risked quickly, all the way to just never doing anything. And that entire spectrum is at your disposal, depending on the levers that are important to you. You're figuring out what to do with this big chunk of wealth that you've accumulated. By the way, good job. Great problem to have.
You won the game. That's what I always say. Again, especially within tech, you oftentimes have gotten there. People underplay the role that luck sometimes has in this. You won. You ended up at a company that ended up being one of the top 10 fastest growing companies of all time. You were compensated extremely well over that period of time. You won. You are now on third base. You're rounding the corner. You don't need to keep hitting home runs. You're there. Just take a step back and be like, I'm there. I can hit my goals. Do I need to be making it more complicated than it needs to be? Like, it's up to you. I think it's like thinking through what are the pros and cons and what are your personal lifetime obligations and goals and like things and strategies that you can do. Think about that return on hassle piece. Don't underestimate the fees that are sometimes associated with these different strategies, the time, and even just like the mental energy versus paying the tax and then it's out of mind. You don't have to think about it in April. I'll deal with it and then roll from there. That's the least amount of mental energy and maybe the highest short-term tax bill. But over time, I think the peace of mind from that sometimes is more worth it.
Totally. You'll get certainty. The rest of this stuff you got to track over time. And there's fees attached to it. You can imagine the more complex the solution, the more bespoke the solution, the costlier it is. So yeah, all this stuff. How much liquidity do you need? And there's just a lot to
And we may,
consider.
again, we didn't go super deep into fees and we didn't go super deep into tracking error. So the assumption all this stuff works is that it ladders up with whatever index that they're tracking. Sometimes that tracking error might end up being a bigger issue. And then a lot of your tax saving assumptions get thrown off from the underperformance of whatever product you're using.
Yeah, exactly. That's probably a good point to call it. This is a super deep talk. We could do multiple hours on every single one of them, but hopefully just a different way to think about this stuff, or even just an overview of the solutions that are out there. I'll just say there are actually more that we haven't talked about, but this will give you definitely 90-10 Pareto distribution overview of the stuff that's out there for investors who are dealing with a good problem.
Good problems to have. Like you've won. So just take a step back and reflect on what your goals are. And again, like my big thing is like, just write down what your goals are. I'm a big fan of that and holding yourself to what you wrote down.
All right, we'll call it there. Thank you everybody for tuning in, spending time with us today. Hopefully we'll do it again. Andre, good to see you as always.
Absolutely.
Thanks everybody.